The last few weeks have been rather brutal for the stock market, and many are speculating that the market is ready for a nice healthy rebound. But is this actually time to get optimistic again with the United States stock market, or are we going to be due for a further correction this time around? What's going on, guys? It's Crypto Dave here with the Top Tier, and in this video I want to break down why I think the stock market is due for a further correction and why this could be the beginning of a fresh new bear market for the United States stock market. We'll talk about some reasonable targets as well as some historical implications and get you guys on the right track for navigating this current period in time. So guys, if you enjoy these market updates and you want more of them, subscribe to the channel, tick the little bell, you'll get notified every single time that we post. Without any further ado, guys, let's go ahead and jump into the discussion. The stock market has underperformed the last month or so due to the Trump tariff war, global tensions, as well as the fear of a real economic recession in the United States. And guys, if you want to learn a little bit more about my thoughts on those things, definitely check out one of our most recent videos where I break this down in further detail. It's going to help set the stage for this video here. But guys, let's go ahead and let's look at the weekly time frame for the S&P 500 index. Of course, this is the top 500 United States companies, so it gives us an excellent measure as to the performance of the United States stock market. And I want to compare and contrast these two periods of time, the first period being from about March of 2020 all the way through to the end of 2021, and of course our current market cycle, which has stemmed from October of 2022 all the way to present day. And I'm seeing a lot of very similar warning signs that the bullish momentum has faded and that we are seeing a trend reversal on the higher time frames that could actually turn into a true bear market for stocks. So let's first talk about the run-up in price. Now, of course, the major run-up that we had throughout 2020 and 2021 could be attributed to the quantitative easing and a lot of the monetary stimulus that was flooding economies around the world. A lot of people had a lot of money and only so much to do with it, and naturally, most financial assets performed extremely well, and we entered sort of a bubble territory for price. Fast forward to our current market cycle, and the narrative has been quite different. We've had some more restrictive monetary policy. However, we did have the narrative of a soft economic landing when it came to the Fed's rate hiking cycle and their attempt to battle inflation without breaking the labor market. At this point, it had been very successful, and the narrative of AI, companies like Nvidia, AMD, some of the AI crypto plays were really taking off here, really shouldering a lot of the momentum and carrying us forward. So we had a fresh new narrative to coast off of, even though the monetary conditions were not quite favorable for markets traditionally. Coming into 2024, of course, we did have the presidential election cycle, which is generally an optimistic time for markets, regardless of who or what is taking place. People do like to have that certainty, and they like to have that optimism of a new way forward. Generally, we do see the stock market perform pretty well during an election year. So that sets the stage as to where these two bull markets really stemmed from and the narratives that really carried them through that period of time. Now, taking it back to the end of 2021, we'll see some very important bearish divergence occurring here on the weekly time frame, where price is setting in higher highs in terms of these candle body closes, but the RSI indicator is setting in lower highs. And what this suggests is that the trend that has preceded this is breaking down and it is no longer sustainable. Surely enough, we saw price drop aggressively. We formed a bearish engulfing candlestick that wiped out several of the previous weeks of trading history in just 1 week. Take it back to our present day, and of course we have the exact same thing. We have a higher high in price here. We have lower highs on the RSI indicator, once again suggesting that our bullish trend is breaking down and that these narratives are no longer going to carry price forward the same way that they had for the past year and a half. Once again, you get a bearish engulfing candlestick, and this wipes out much of the previous trading history, and it takes us back into this EMA cloud here between the 21 weekly EMA and the 50 weekly EMA. And this is a very important moving average cloud. We use it on a lot of assets and a lot of different time frames, specifically the weekly or the daily time frame. And you'll notice again, back in 2021, this bearish engulfing candle took us well within the EMA cloud, and we were no longer able to continue to hold this cloud as support on the weekly time frame the way we had preceding the breakdown in the trend. We eventually came down, we swept this level here on the S&P. We had a nice little relief rally that captured some liquidity above the EMA cloud, but ultimately we saw the downtrend being confirmed here. We set in a lower macro high and we continued downward. And this was a 280-day bear market that took about 27.5% of the market's value with it. And this is not crypto, so a 27% correction is absolutely massive. Once again, taking us back to present day, our bearish engulfing candlestick has broken us below our EMA cloud, and once again we are fighting to reclaim the EMA cloud as a higher time frame support. And so at this point in time, what we want to be looking at is the potential for a lower high here, sort of above the EMA cloud, once again, where we grab that liquidity, some of that optimism returns to the market, people are back on board and bullish, and they are getting captured here at this point of liquidity before moving back down And we might even sweep these lows here right around the 5,400 point mark on the S&P before we really continue up. But it looks like these lows are actually being front run. And so we are getting that relief rally at this moment in time. So I just want to put it on your radar that should we set in a lower macro high and continue downward, it is very likely that this is a true bear market and that we are going to see more of an extensive correction than just a couple of weeks of dipping before going back upward. Now, if we are looking at a true bear market for stocks, I would first direct your attention to this 100 weekly EMA here, this yellow line. I think this would be the first point of interaction, potentially finding some temporary support, but I would also turn your attention to this 200 weekly EMA that has acted as support for the stock market in previous bear market declines. We saw the COVID crash take us well below the 200, but a quick and rapid recovery was made. We saw the last bear market take us right down to the 200. We tagged it perfectly and got a bounce. We also grabbed some liquidity below before finally setting in that bear market bottom. So those longer term moving averages are going to be rather important. But guys, all in all, I am seeing a clear technical breakdown in the United States stock market, very similar to the last one we saw in 2021 heading into 2022. And I just want you guys to be cautious because even though narratives change seemingly every day and it's very easy to get emotional, we need to stay rational and objective about what price action is telling us and what information we can gather from the chart. And guys, if you want to find out how I'm strategizing these market conditions, definitely consider joining the Discord. You'll get access to myself as well as 20 other trading analysts between stocks, crypto, and Forex to help better your trading game. Guys, until the next video, I will catch you in the Discord. Peace.